Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
And Paul was pointing out earlier that we got some of that economic data, factory orders lower for April. You also had JOLTS job openings coming in better than expected. The quits rate also slightly better, although we are seeing more people getting fired or laid off. So I want to take that into account with Ira Jersey, Bloomberg Intelligence senior U.S. interest rate strategist. You're seeing a little bit of selling on that front end. Hey, Ira, what's your take on these numbers?
Yeah, I disagree with that take, actually. The way that I look at quits being down a little bit and then layoffs being up a little bit is actually weak for the economy, because if you're not thinking you can find another job, that's the reason you don't quit your job, because you need to stay where you are. And then obviously with layoffs up, that's not particularly positive either. But it's all very incremental. These aren't huge moves, and certainly job openings being up a little bit in April, still not back to February levels. So again, we're talking about maybe lower highs here in terms of the downtrend. But some of the other data is also important to look at. So you think about factory orders, those missed to the downside, plus they were revised down as well the prior month. So overall, this is a little bit of a weak economy, and the front end selling off, so 2-year yields being a little bit higher here, is a little bit surprising, because yes, the data isn't terrible, but it's also not particularly good either.
Kind of, no matter how you slice it, Ira, it seems like this Federal Reserve is not really getting any clear signals what to do next, which I guess for a lot of folks means let's do nothing here. How do you think they're going to interpret today's data?
Yeah, well, I think that they're going to not be pleased with today's data, but at the same time, they're waiting for the next shoe to drop on inflation, right? So next week's inflation print is going to be important, as well as this Friday's payrolls report. But the likelihood that the Federal Reserve does anything at the June meeting is near zero, because they're waiting to see what the fallout is of all the tariffs. Will that increase prices? How will that affect inflation and the inflation outlook? So all of those things probably mean that they sit on their hands. In fact, the minutes last week, according to our natural language processing model, suggested that they were as neutral could be at the last meeting.
Yeah, he does this thing, and it's really cool. You put in Fed speak, and then his model tells them whether they're on the bullish or the bearish side, or I guess hawk or dove side, if we're putting it in Fed terms. So walk me through what you're expecting then for Friday and how we're positioned in the market, because honestly, it's been pretty calm the last 2 days.
Well, so one of the things that we've noted, and I was talking to our derivative strategist Tanvir Sandhu just this morning, and he noted that for long end, right? So we've had this lot of angst with what's going on in the 30-year debt and even 10-year debt because of the fiscal situation and the fact that we're not really paying down deficits very much. That people are long puts, right? So people have gotten out of the money puts on long bonds. So therefore, it might be more difficult for the long end to sell off, just because people are appropriately hedged. But I do think that there's a lot of people who are kind of waiting and seeing what the economic outcome is going to be. But that being said, there are people who are nibbling at the edges, particularly when you get up to that 5% level in 30-year bonds, because liability-driven investors, so insurance companies, pension funds, and a few others, they're really interested in treasuries at 5%. So I think that's another reason why you keep on seeing a bid every time we kind of get above that 5% level on the long bond.
Long ago, Ira, Lisa Abramowitz taught me to look at the 210 spread there, and right now it's about 50 basis points of steepening. That feels kind of normal to me, or kind of reasonable to me. How does it look to you?
Yeah. So actually, on a historical basis, it's actually still kind of low. Normally, when you look at the 2s-10s curve, it's somewhere closer to 100 basis points on average. We do think there's some structural reasons why I'm not sure that we'll get up to where it has during other cycles. But I do think that steepening is still probably the trade, whether it's bull steepening or bear steepening. We're more likely to see steepening than we are significant flattening, I think, over the next 6 months. The fiscal situation and end will likely keep the long end where it is, or maybe even actually have that cheap end, so yields going a little bit higher. But as the economy slows, which is our base case scenario over the course of this year, it will become more obvious that the Fed is going to cut rates, and cut rates maybe more aggressively than what's currently priced, and that will cause two-year yields and the front end of the yield curve to rally and yields go lower. So that will steepen the yield curve. So we think that over the course of this year, one way or the other, whether it's bull or bear, we'll see more steepening of the yield curve.
Right, bull or bear, like do you get it on the front end and that's why the curve goes up, or do you get it on the back end and that's selling in the long end, and do we get that higher? Ira, thanks a lot. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist, joining us there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Today, the OECD, which is an international trade organization based in Paris, they slashed its government economic forecast due to Donald Trump's trade policies, citing the impact of tariffs and uncertainty on confidence and investments. Maybe we're starting to really see some impacts there globally. Zoe Schneeweiss joins us here, Western Europe economy team leader. She's based in Frankfurt. Zoe, thanks so much for joining us here. Specifically, what is the OECD calling out for the U.S. and for the global economy?
So overall, the OECD, as you just mentioned, just cut its forecasts across the board. And like for the world, they were predicting for this year 3.1% growth. Now it's just 2.9. Similarly for the US, even more drastically actually, for the US they were predicting 2.2, and now they just say 1.6. And they also next year for the US just predict 1.5% growth. So overall, these are quite dramatic numbers. And throughout the whole report, the reason they give for this is Trump tariffs, and that there's overall this combative trade policy that's coming from the U.S. just is hurting the world all over, but the U.S. here in particular.
Mm-hmm. But Zoe, I wonder what their baseline is for tariffs. Is it at 10%? Are they taking into account the tariffs that are currently in place? Like, what's that tariff scenario?
The tariff scenario is just general uncertainty. So they are very aware that because of the constant change of Trump policy, that he says one tariff one day and then changes again the next, and then goes back and forth all the time, that there just is this inherent uncertainty here that will just hurt trade overall. If you look at the charts that say what trade would do if you compare it with what they thought in December and what they're saying now, the picture is just incredibly dramatic. And they say that as long as this is there, as long as this uncertainty and this constant, what's it called, there and back again kind of trade policies going on, that this is something that will just hurt the economy almost irrespective of what the tariffs are actually like then. Just that uncertainty damages so much.
Zoe, you're based in Frankfurt. Based upon my travel through Europe, I've always considered Frankfurt to obviously be the corporate hub of Germany and certainly much of Europe here. What are you hearing from the German executives that you speak to about what we're seeing over the last several months?
So Germany is in an interesting situation because we just had elections here in February, and there then a coalition was formed quite quickly. And even before the coalition was formed, because the fringe parties on the left and the right won so much in parliament, they still, in the lame duck parliament, still passed an incredibly generous fiscal package and also this huge defense package. So the defense package, we know it's tricky how this will trickle through with the economy, but the fiscal package is really massive, and also just generally gave our executives here in Germany a whole boost of confidence, because Germany, as we know, red tape here everything takes ages. Red tape is very prevalent, and during the entire Scholz the time that Scholz was chancellor, the economy barely grew. There was 1 quarter of contraction, 1 of growth. It just was really very, very sad. Mm-hmm. And so the fact that there would be this huge fiscal package made everyone happy. This was February. Then we got Liberation Day from the U.S., and that has made them more uncertain. Overall, though, given the uncertainty there where this hurts investment, that hurts all that, but the fact that there is this huge fiscal commitment does make executives a lot more confident than they were.
All right, Zoe, thanks a lot. Really appreciate it. Zoe Schneeweiss, Bloomberg Western European Economy Team Leader. She just heads up all the stuff over there in Frankfurt. So she's in Frankfurt, and Paul and I are here in Maryland.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We are in Maryland, right at the National Harbor at the Gaylord Convention Center, as we have a lot of financial advisors kind of coming together and discussing ideas and how to manage asset and wealth management for 3 days of learning experiences and networking solutions as well. Really been a fascinating time so far. Keeping an eye on some of the equity moves. One is Meta and Constellation. Constellation Energy is up a little over 0.5%. Meta's down by 0.5%. But Constellation Energy agreed to sell power from an Illinois nuclear plant to Meta Platforms. It's a 20-year contract starting in mid-2027. So Constellation is going to boost its own investment into the Clinton plant's output and maybe will actually build another reactor at the site. I did the energy angle. Let's get the tech angle now with Mandeep Singh, Bloomberg Intelligence Senior Technology Analyst. Okay, Mandeep, why does Meta need this?
Well, if they're raising their capex, which they did in their last earnings, that capex is going towards, getting more AI chips. And, if you are putting more AI chips, you need more power. So clearly, that is where the shortage is right now. And look, if this is an AI super cycle that we all believe it is going to be the case, and I think you will see a power super cycle as well. And in this case, all the hyperscalers will be looking to procure power for their data centers. I mean, Meta serves over 3 billion monthly active users across their family of apps. Now, granted, those users right now are using more CPU compute, but if you're rolling out AI tools and LLM searches, you need more power for the AI chips, and I think that's the intent here.
Hey, Mandeep, let's be honest here. I mean, all you tech guys, you Silicon Valley guys, you always think you're the smartest guys in the room. But let's be honest, you guys don't know anything about the oil and gas business and the nuclear business. Why is Meta, and I'm guessing some others, are going to kind of get more deeply and strategically involved in the energy side of their business? Is this a trend here?
I mean, just look at how far they have come in terms of, infrastructure. Like a company like Google, not only are they designing their own data centers and, creating their own chips, and now they are, procuring power to the extent that they want to make sure that these AI chips, which can have volatile power needs, are most optimized when it comes to the efficiency of their infrastructure. And that's why these hyperscaler companies really have got so many different aspects to their moat. So it's not just about the search algorithm, or in the case of Meta, their social media knowledge graph. It is about the entirety of how they run their infrastructure, and that is what is a long-term moat, because nobody else can operate at the scale at which these hyperscalers are operating right now.
This is a fun fact in the article by Will Reid from Bloomberg. So Meta, first of all, has a global energy head.
They have a global energy head.
Yeah.
Okay, all right.
So they do. They're really kind of ramping that out. And they were looking at proposals. They announced in December they were looking at proposals for as much as 4 gigawatts of new U.S. reactors, and it received 50 proposals from a range of companies, including Constellation, to that point. I'm also wondering, Mandeep, the significance of when they're building data centers and hyperscalers for LLMs, a large language model, and that training, versus when they have to build stuff for inference, which could be smaller and more co-located, so closer to the cities, closer to where Paul and I have our phone. Does that tend to look different then in terms of their power needs?
Absolutely, and I think so far the market was concentrated towards training. Every year you would have a 10 times larger model, which was more intelligent, and it could do more in terms of answering your queries. But with inferencing, you're right. I mean, the traffic patterns may vary depending on the population, And so if you're serving traffic in New York, it's very different from serving traffic somewhere else that may not have the same concentration. And with that, I think the challenge these companies have had is the transmission lines can't be upgraded. I mean, you need, a pretty lengthy review process, and the whole thing may take years. So right now, they are trying to procure power wherever they can to offset the increased consumption, and some of it may come at the expense of power usage for some other purpose than why data center is being prioritized here. And that is what will be interesting, because with inferencing, the power needs can be variable. I mean, one trend we have seen is with reasoning, you need more compute. So, the model is thinking a lot more at the time you are putting the prompt in, as opposed to training, where all of the training is happening in background over a period of few weeks. So reasoning is per query, and depending on how complex your query is, the model is doing more work, and that's why it may need more power.
Another data point from this Bloomberg News article: Meta is contracting for more power after the company's total electricity consumption nearly tripled from 2019 to 2023. So, yeah, I guess they need some more energy. Mandeep, is this in the CapEx numbers for Meta and for these other tech companies, or do they need to take those CapEx numbers up even more if they're going to get deeper into the energy space?
I mean, all signs are the CapEx numbers may continue to go up, but right now the biggest component of the CapEx is still the spend on the GPU chips. Obviously, the power needs will take some portion of the CapEx, but it's still not as big as the chips. And think of it this way: if you're getting 20,000 NVIDIA chips, the cost of keeping them idle or not being able to utilize them 100% is way higher than anything you are spending in terms of, the energy deal that they had. So clearly they are focusing on utilizing the chips that they have already procured, and that's why they are proactive with, these power deals.
All right, Mandeep, thanks a lot. Really appreciate it. Mandeep Singh joining us, Bloomberg Intelligence Senior Technology Analyst.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Happy Tuesday, everybody. Alix Steeler alongside Paul Sweeney. We are live from BNY Insight 2025. We are in National Harbor, Maryland, at the National Harbor, Maryland, at the Gaylord Convention Center for this tremendous event. Over 2,000 people are here. They talk about ideas. They exchange thoughts about the markets and wealth management and private wealth and alternatives. It's a pretty exciting, dynamic place to be. And joining us is one of our favorites, Phil Orlando, Chief Equity Market Strategist and Head of Client Portfolio Management at Federated Hermes. Phil, always good to see you.
Alix, thank you so much for having me back. It's a thrill.
You've been coming to these for a long time, right? So
yeah.
What's the different vibe here this year? Is there one?
The vibe is very optimistic.
Really?
There is more of an emphasis on technology today and AI than there ever has been, but that probably it's not surprising given the evolution of the business. I've always found these conferences to be very cutting edge in terms of what are the key issues that are going to be driving us in the months and years forward, and so far I haven't been disappointed here today.
Phil, just looking at the S&P 500, we've almost completely round-tripped peak to trough, back up to peak here. What do you make of that? I mean, that was a short period of time. We saw big moves in the marketplace. What do you do looking forward for the next 6 months?
Oh, more to go.
Okay.
I mean, remember, our full-year target for the S&P this year is 6,500. We've got a 7,000 next year. So, yes, we've had a really nice bounce off of that support level. I think we're up about 23%. On the S&P 500, but again, not surprising to us because that waterfall decline was largely a function of the uncertainty relating to the tariff situation, and to some degree, how is the tax legislation going to work? We're starting to get some early resolution of exactly, at least directionally, how that's going to play out. And the market at that point should begin to think about, okay, what are the underlying fundamentals, not the chaos associated with what caused the decline back in, early April.
All right, let's pretend that we can put aside the chaos then for a second. Does that mean that tech continues to lead, or do we get the broadening out?
Well, yes.
I was going to say, or can both be true?
So our feeling going into the collapse was that the rally did need to broaden out. We were de-emphasizing sort of the technology and the Mag 7 names because we felt that they were ahead of themselves. So the area of focus for us was the forgotten 493, the value names, the international names, the smaller cap names. But as the market came down 21%, the Mag 7 names were down 45%. So as we started to put additional money to work, we increased our equity allocation to a 5% overweight near the bottom. That incremental add for us was in domestic large cap growth. Okay. So we recognized that 45% down was actually an attractive point to start to put some money back to work.
With a little bit of hindsight, as we think back to that sell-off in April, a couple of things kind of come to mind. Number one, we had people during the sell-off telling us, people aren't panicking out there. That's number one. And number two, retail is buying. What is that? What are those two things to kind of tell you? They kind of, I guess in hindsight, I would have said, boy, I should have been buying there because the retail guys are buying. I don't think I really saw on panic selling. Yeah.
We've done some work looking at the performance of the market literally over the last half a century.
Okay.
And over that period of time, there have been 10 massive declines, 20% or more, 20, 30, 40, 50. And in every instance, that was a great buying opportunity. That over the long cycle, the ingenuity and hard work of the American people, stocks up and to the right. So if you look at those big declines down and think you understand what the underlying fundamentals are, that to us was a reasonably and attractive buying point.
Mm-hmm. So how do you look at, I know we talked about this before, but how do you look then at the next 6 to 8 months as you manage the uncertainty? You just be really strategic, you have your buying list, and you think of it that way, and you kind of ignore the actual headlines?
Well, we take a longer-term perspective. Mm-hmm. We're looking at 6 to 12 to 18 to 24 months. And as we look at that perspective, the noise and the nonsense and the chaos associated with the day-to-day, we sort of screen out.
But some of those things could be structural.
They could be, and if they were structural, we would change our view. But we've got a view that for example, our GDP forecast for next year is 2.7%. All right, that doesn't sound like much, but consensus is 1.3. Yeah. The highest estimate on the street, other than us, is 2%. So we think that things are going to work out over the course of the next 18 months, and if we're right, we want to be buyers of stocks in that environment.
Do we still have earnings risk? I know earnings estimates have come down, but do we still have earnings risk, do you think, out there? Because we still have tariffs that are going to be gradually rolling into the economy.
There's always earnings risk, but we just got through the first quarter, and revenues were up about 5%, earnings were up about 12%. Those numbers were better than expected. We've sort of adjusted our full-year numbers based upon the implementation of tariffs, but that trajectory is still positive.
All right, Phil, really great to chat with you. Good to see you in person. It's so weird when he's just not on a screen. Phil Orlando is Chief Equity Market.
Thank you very much for having me on.
You bet. A Chief Equity Market Strategist and Head of Client Portfolio Management at Federated Hermes, joining us on the market.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.